Warren Buffett's renowned quote, "Price is what you pay, value is what you get," has become a cornerstone in discussions about investing. However, its true meaning is often misunderstood. Many investors mistakenly equate a low price with a good deal, overlooking the underlying value of what they are purchasing. This misinterpretation can lead to risky decisions, as focusing solely on price may result in acquiring assets that lack real worth. Buffett's words serve as a reminder to look beyond the numbers and assess the genuine quality and potential of an investment. By understanding the distinction between price and value, investors can make more informed and prudent choices. A frequent mistake among investors is to equate value solely with cheapness. This narrow perspective often results in one-dimensional investing, where decisions are based purely on low price tags, rather than a comprehensive assessment of a company's true worth. Relying heavily on stock screeners to filter for the lowest price stocks can be misleading, as these tools typically overlook important factors such as growth potential, financial health, and competitive advantages. By focusing only on price, investors risk missing out on quality opportunities and may inadvertently select companies facing significant challenges. True value investing requires a deeper analysis that goes beyond surface-level metrics, ensuring that investments are both attractively priced and fundamentally sound. In investing, it's important to distinguish between price and value. Price is simply the amount of money required to purchase an asset, a clear and objective figure displayed in markets. Value, on the other hand, is far more complex. It represents an investor's assessment of what an asset is truly worth, based on factors like future earnings, growth potential, and risk. Determining value involves careful analysis and informed judgment, often leading to different conclusions among investors. While price is easily observed, value must be thoughtfully estimated, making it a central concept in sound investment decisions. The concept of buying undervalued stocks, often referred to as the cigar butt approach, was popularized by Benjamin Graham. Graham advocated for investing in companies that appeared statistically cheap, even if they had only a small amount of value left to offer, much like picking up a discarded cigar for one last puff. Warren Buffett initially followed this method, seeking out bargains based purely on financial metrics. However, over time, Buffett recognized the limitations of this strategy. He saw that focusing solely on statistical cheapness often led to investments in mediocre businesses with poor long-term prospects. Buffett had evolved his approach to prioritize quality companies with durable competitive advantages, even if they weren't the absolute cheapest by traditional measures. This shift allowed him to achieve more sustainable and substantial returns over the years. Charlie Munger brought a pivotal shift to Warren Buffett's investment approach by emphasizing the value of acquiring exceptional businesses at reasonable prices. Prior to Munger's influence, Buffett primarily focused on purchasing average companies at deep discounts. Munger argued that long-term success comes from owning high-quality companies, even if they aren't available at rock-bottom prices. This insight encouraged Buffett to seek out businesses with durable competitive advantages and strong management. The transformation led to investments in iconic firms such as Coca-Cola and American Express. By prioritizing quality over mere bargain hunting, Buffett's portfolio achieved greater stability and growth. Munger's refinement remains a cornerstone of modern value investing. Warren Buffett and Charlie Munger define value as a multi-layered concept that goes beyond simple financial metrics. At its core, value begins with a durable competitive advantage, qualities that allow a business to maintain its edge over rivals for years to come. This could be a strong brand, proprietary technology, or cost leadership. Next, competent management is essential. Leaders must be skilled, ethical, and capable of steering the company through changing environments. Finally, future earning power is critical. Buffett and Munger assess a company's ability to generate consistent and growing profits over time. By combining these elements, they seek investments that offer lasting worth, not just short-term gains. When discussing value, it's common to rely on popular financial ratios like price to earnings or market capitalization. While these metrics offer a quick snapshot, they often oversimplify the complex reality of what makes a business truly valuable. Prudent interpretation goes beyond surface-level numbers, requiring a deeper understanding of a company's operations, competitive advantages, and long-term prospects. By focusing solely on financial ratios, one risks overlooking critical factors such as leadership quality, innovation, and market dynamics. True value emerges from a comprehensive analysis that integrates both quantitative data and qualitative insights. This approach ensures more informed decisions and a clearer perspective on a company's genuine potential. In today's markets, the allure of cheap stocks can be deceptive. Many investors are drawn to companies trading at low valuations, hoping to uncover hidden bargains. However, these stocks often remain undervalued for a reason. Deteriorating business fundamentals, declining revenues, or outdated business models can keep prices suppressed, making them value traps rather than opportunities. Superficially attractive metrics may mask underlying issues that hinder future growth. Without a thorough analysis of the company's prospects, investors risk buying into businesses that continue to struggle. Understanding why a stock is cheap is crucial to avoid the pitfalls of value traps. When analyzing speculative assets, such as cryptocurrencies and commodities, applying traditional value analysis can be misleading. Unlike stocks or bonds, these assets do not generate earnings or cash flows that can be used to estimate their intrinsic worth. As a result, attempts to assign a fundamental value often rely on subjective factors or market sentiment, rather than objective financial metrics. This can lead investors to overestimate the reliability of their assessments and make riskier decisions. The absence of intrinsic earning power means that prices are driven largely by speculation, supply and demand dynamics, and external events. Consequently, value analysis may provide a false sense of security when navigating these volatile markets. Relying solely on price drops as a reason to invest can be a dangerous approach, especially when the underlying business is not well understood. A falling price does not automatically signal a good opportunity. It may simply reflect deeper issues within the company. Before considering any investment, it is essential to determine the true value of the business. Understanding its fundamentals, prospects, and risks provides a solid foundation for decision-making. Only after establishing value does the price become a meaningful factor. This disciplined process helps avoid costly mistakes and ensures that investments are based on sound reasoning rather than speculation. A prudent investor begins by thoroughly analyzing a business, seeking to understand its fundamentals and estimate its intrinsic value. This involves evaluating financial statements, management quality, competitive advantages, and long-term prospects. Once a reasonable assessment of value is established, the investor does not rush into buying. Instead, patience becomes key as they wait for the market to present an opportunity where the price falls below the estimated intrinsic value. By following this disciplined approach, the investor aims to minimize risk and maximize potential returns over time. Focusing on value rather than short-term price movements can offer a sense of psychological peace for investors. By concentrating on the underlying strength and long-term prospects of a business, individuals are less likely to be swayed by daily market fluctuations. This approach fosters resilience, helping investors remain calm during periods of volatility. Owning businesses with predictable cash flows further enhances this stability, as steady income streams provide reassurance even when markets are turbulent. Such investments allow for more confident decision-making and reduce the urge to react impulsively to market noise. Ultimately, prioritizing value and reliable cash flows can lead to a more disciplined and less stressful investment experience. Warren Buffett's famous quote can be interpreted as a powerful reminder to approach investing with intellectual honesty and rigorous analysis. Rather than relying on gut feelings or hearsay, successful investors commit to thoroughly understanding their decisions and acknowledging their limitations. This mindset distinguishes professionals from amateurs. While amateurs may be swayed by trends or emotions, professionals maintain discipline, question their assumptions, and seek evidence before acting. The professional approach prioritizes long-term value and careful research, whereas the amateur mindset often chases quick gains without a solid foundation. Ultimately, intellectual honesty and diligence are what set expert investors apart in the marketplace. As we wrap up, it's important to consider which companies truly offer lasting value, not just short-term gains. Reflecting on their strategies and impact can help us make more informed decisions as investors and consumers. In future segments, we'll explore additional topics that shed light on market trends and emerging opportunities. Your thoughts and perspectives are valuable, so feel free to share your insights in the comments. If you found this discussion helpful, engaging with the channel helps us continue providing content that matters to you.